Our topic today is fiscal policy. This topic is relevant for all students taking economics in the college. In this presentation, we will first be identifying the instruments of fiscal policy, and secondly, analyzing the expected lines of causation from an expansionary fiscal policy. In part 1, we will try to fulfill the first two assessment objectives of your course, which is knowledge and application of this topic. We will be identifying and providing examples of instruments of fiscal policy. Just a quick recap. Fiscal policy is one of the two demand-side policies that you need to know for your course. The other is monetary policy. This means that the line of causation developed later will always relate to changes in aggregate demand. As defined in the definitions list, fiscal policy is the manipulation of government spending and taxation to change the level of output in the economy. This means that both the government spending and taxation are known as the instruments of fiscal policy. Just a quick reminder, please make sure that you download the definitions list from Canvas if you have not. It's in the Files section under the folder Definitions. Taxation can include both direct and indirect taxes. Direct taxation is levied on income, wealth, and profit, such as income tax and corporation tax, while indirect taxes are taxes on spending, such as VAT and excise duties of fuel, cigarettes, and alcohol. Government spending can be divided into a few categories as well. The first are transfer payments, such as unemployment benefits, state pensions, and child benefits. Secondly, current government spending, which include expenditure on state-provided goods and services such as salaries paid to the doctors, nurses, and teachers. And the third category includes things such as infrastructure spending on hospitals and schools, which are called capital spending. Alright, now that we know what are the instruments of fiscal policy, fulfilling the first and second assessment objectives, which are knowledge and application, we can now move on to the second part of this presentation, which is to develop the expected lines of causation from an expansionary fiscal policy. This will fulfill the third assessment objective of your course, which is analysis. There are two fiscal policy stances, expansionary and contractionary. In very simple terms, an expansionary policy is a policy to make an economy bigger, while a contractionary policy is to make the economy smaller. The word stances means the position that someone takes in a certain scenario. In this case, the position that the government takes with regards to what they do with their budget, i.e., their fiscal position. If you're still not sure what it means, or in any of the words in this presentation, please make sure you take the time to pause the presentation and translate the words into your own language to ensure full understanding. In today's presentation, we will only look at the expansionary fiscal policy stance together, but I would like all of you to independently form similar lines of causation for contractionary fiscal policy after watching this. So, what does an expansionary fiscal policy actually mean? Expansionary fiscal policy is when the government increases spending and reduces taxes to stimulate aggregate demand. But why would a government want to stimulate aggregate demand? Think about the macroeconomic objectives introduced in the previous chapter. Pause this video for a while to think about it. Okay, so the most likely reason for this is to increase economic growth or reduce unemployment. In this presentation, we will focus on how increases in government spending in general and decreases in income tax and corporation tax can lead to this. The causal links are developed in the next few slides. We'll first look at government spending and how it relates to the ADAS diagram analysis. You'll also be able to use similar analysis for taxes later on, so make sure you fully understand this slide before moving on. When the government increases spending, such as on education and healthcare, this will stimulate aggregate demand. Don't forget, government spending is a component of aggregate demand. With an increase in AD, there will then be an increase in economic growth. This can be shown in the diagram, where an increase in AD represented by a shift from AD1 to AD2 leads to a rise in GDP represented from Y1 to Y2. Please don't forget to make a connection between this diagram and your written analysis in your exam responses as shown in the slide right now. Expansionary fiscal policy can also take the form of a decrease in income tax. The lines of causation is nearly the same as before, but there's a few extra steps that you need to explain. The steps are as follows. When there is a cut in income tax, there will be a rise in disposable income, which will then lead to a rise in purchasing power, and consequently a rise in consumption. This will lead to a rise in aggregate demand, as consumption is a component of aggregate demand, leading to economic growth. The diagram that you draw will be the same diagram as shown in the previous slide. The other common instrument of an expansionary fiscal policy is cutting corporation taxes. Remember, corporation tax is a tax on a firm's profit. In some other countries, they might call this profit tax. So, with a cut in corporation tax, there will be a rise in potential after-tax profits. This will then encourage investments, which would then stimulate aggregate demand, as investments is a component of aggregate demand. Similarly, if there is a cut in corporation tax, firms get to keep more money after paying their corporation tax, which could lead to further reinvestments into the economy. This is also counted as investments in the aggregate demand calculation. Therefore, with a rise in aggregate demand, this will lead to economic growth. Now, I would like all of you to use the lines of causation developed in the previous slides, but reverse them to represent the lines of causation that would occur if there is a contractionary fiscal policy. Remember, a contractionary fiscal policy is when the government decreases spending and increases taxes to decrease aggregate demand. Write your responses down and bring it to class the next time we meet. This is now the end of the presentation. Thank you for listening. If you have any questions, please ask by replying to this post in the discussion section on our Canvas course. Goodbye.